Okay everyone, so today we're going to talk about some of the most underrated yet the most critical tools in any investor, especially when it comes to retail investing. Tools is an Investor Rulebook. I'm going to share with you some of the items that are my personal favorites, some that are pre-fundamentals, fundamentals, and operational. Let's get into it. So, what technically speaking is the rulebook? It's a set of rules predefined before you are going into investing journey for that particular asset or asset class, technically describing if happens this, I will do what. Why it's important? Because when the markets go down and you see everything in red and you are maybe down 10, 20, 30%, your stress level rises, and stress is a very, very bad advisor on what to do in any given circumstance. Therefore, it makes a lot of sense to forecast certain scenarios prior for them to happen, and this way act accordingly when the situation comes. So first and foremost, you need to know your why. What do I mean? You need to know why you own something. What are your fundamentals, momentum, trading objective? Why you buy certain assets? And it makes a lot of sense to also take a note of this why on paper. Additionally, I would like to mention that why, as a friend's advice or anyone's advice that has not been fully absorbed by your mind and your understanding, is rarely a good idea, because as it comes for retail investing, there is no two people are the same, and therefore there is no two portfolios are the same. And in the case your why is highly borrowed from somebody else and lack 100% conviction, you may find yourself quite restless, reacting highly emotionally towards any line of news, change in valuation, and overall increasing your probability to do a mistake. Second thing is understand the waters you are swimming in. Stock market, or for that matter, asset management, is an environment with a number of players playing by largely different rule sets. For example, retail investors, they would buy hoping that the price is going to go up and possibly that they are going to benefit from the payouts. Then you have pension funds, mutual funds, they play slightly different game. Then you have hedge funds, you have banks, you have exchanges. All of them are playing by slightly different roles. And in order to succeed, you need to understand those roles. So, point number 2, understand your environment. Another is invert, always invert. This originally belongs to Charlie Munger, and it does describe the idea that before going into any asset or asset class, you need to try and imagine how this can result in an absolute disaster and define for yourself those criteria. So at any given moment that you will see the situation is developing that way, it's a very good sign for you to consider or actually reconsider whether or not you want to continue holding this particular asset. Use stops religiously. Coming back to point number 1, know your why and describe for yourself not only why you own something, but when are you planning to exit the position, or what can make you close this position, and add your stop losses accordingly. Let your profits run. If you bought an asset and you see that it's going up parabolically, let it run. Nobody knows, not Warren Buffett, not Jimmy Dimon, not Federal Reserve, where exactly it's gonna stop. But I can assure you of one thing only, that it's gonna stop at some point, and this is when you want to start selling. When it just starts tipping in an opposite direction. In some cases, you can catch this moment if you are just being glued to the screen. In some other cases, you can be moving your stops on every single given day. Another basic rulebook principle is don't catch a falling knife. So, for example, if you have a position and you see it's falling in price, first and foremost, do not expect that you just need to wait a little bit and it's going to go up. Maybe it will, maybe it won't. You're not going to know. But if it will not go up, you're going to lose money, time, and confidence. And more importantly, your peace of mind, which is very important in investing. So the moment you see your asset is going down in price and the delta is more substantial than it will take for you in commissions to exit the position and buy something else, it's time to say goodbye. Speaking of commissions, know how much you pay and plan your assets accordingly. Every single time you see or hear 0% commission trading, my friend, I can absolutely assure you it is an absolute marketing trick. And if you are paying 0% in commissions for some part of a trading, be prepared that you're gonna pay a hell lot of commission on some absolute nonsense. It could be currency conversion, for example. And know there's commission levels. Because also, in the case you, at some point in time, you will go into high frequency trading, commissions will be your highest spend ever. So know the roles you're playing by. Understand what you own to such an extent where you can comfortably operate with that particular asset P&L. Understand that EPS is pretty much nothing. What you really want to pay attention to is price to book, price to earnings, and the dividends. And run your models, or at least try to calculate what are you going to achieve if you hold this asset for certain periods of time. Understand your risk profile and the risk profile of the assets you are considering to buy. And what is your risk tolerance to begin with? Because the risk tolerance of the person who is trading on the recreational assets, or someone who is trading professionally speaking, someone who is in their early 20s and someone who is 60 plus is very, very different. So you need to be aware of it, and you need to understand where specifically you are in that journey, and choose your trades or assets owned accordingly. Because in some cases, misunderstood risk tolerance can result in very dramatic, negatively speaking, results. Risk profile of the companies. Quite a few times I have had the chance to come across brilliant ideas of retail investors where they would get highly excited over innovative company that has 10 people or full-time employees, did not produce any meaningful outcome product-wise and generated zero revenue, and they would ask if that's a great investment to buy. Well, my position on this is, think of it this way: the risk profile for this company versus risk profile for the company that has billions or hundreds of billions in revenue, tens or hundreds of thousands of employees worldwide, stable product. How would you compare all this to? And don't take it the wrong way. I would not say that company number one is not going to be successful, but it can take 10 years, and you're gonna hold your capital for 10 years, assuming they would not go bankrupt. And possibly then you can have this parabolic hockey stick breakout. But unless you have enough capital and time to wait until then, maybe this is not the best thing you can do with your capital today. If you are a venture capital firm or personal watching this video, it's not for you. You are in a highly different business. But if we're talking about the retail investing, you want to have companies that are either stable or on the verge of breakout. Another important thing to understand, that past performance is not a guarantee for the future performance. You see, in credit-based economy we're currently living globally, we cannot hope anymore that you can buy a certain asset class, live it, and it's going to deliver pretty much until the end of days. This was true until certain time in the past, quite a few decades in the past, but it is not the case anymore. So you always need to think where the capital flows currently, how it's rotating, and how you can benefit from it while offsetting some of your risks. And I will be more than happy to expand on this in upcoming videos. Meanwhile, I hope you find it useful and educational. Additionally, I would like to highlight one more thing. Last, but probably the most important in the rulebook, is invest in your education. You can do it in several different ways. Where number one, you can essentially learn from people who know how. Two, you can learn from the mistakes of people who know how, which, by the way, to my personal opinion, it is some of the most efficient and sophisticated ways to learn. And option number three, you can learn by acquiring knowledge through books, videos, and overall learning the topic. It's going to take some time. You're going to do some mistakes. But even if you do mistakes and you lose money on it, it's still an acquisition of knowledge. So it is still an investment. It's just important to not lose too much.